Most traders wait for confirmation before entering a trade, and that's exactly why they're always late to the party. While average traders are still analyzing their fifth indicator, elite traders have already captured the majority of the move and are managing their profits. The difference between consistently profitable traders and those who struggle isn't access to better tools or secret indicators, it's understanding how institutional money moves and positioning themselves ahead of the crowd. What separates someone making 5% monthly returns from someone barely breaking even comes down to entry timing. And today, you're going to learn exactly how the top 1% of traders identify and execute early entries that most people completely miss. The foundation of early entry trading starts with understanding market structure in a way that textbooks don't teach. When you look at any price chart, you're not seeing random movements or chaos. You're witnessing the footprints of institutional orders being filled. Banks, hedge funds, and proprietary trading firms don't just click buy or sell like retail traders do. They accumulate positions over time, creating specific patterns in price action that reveal their intentions before the obvious move happens. Elite traders have trained themselves to read these patterns like a language, spotting the accumulation phase while everyone else is waiting for the breakout. The key insight here is that by the time a trend is obvious to the majority, the early opportunity has already passed, and you're entering precisely when smart money is looking to take profits. Order flow is the secret weapon that elite traders use to see inside the market's intentions. Unlike lagging indicators that tell you what already happened, order flow shows you what's happening right now in real time. When you understand how to read the tape, you can see aggressive buying or selling before it shows up as a significant price movement on your chart. Imagine watching a dam that's about to break. You can see the cracks forming, the water pressure building, and the structure weakening before the catastrophic failure occurs. That's exactly what reading order flow provides. Elite traders watch for imbalances between buy and sell orders, absorption where large orders are soaking up one side of the market, and exhaustion where one side runs out of participants. These signals appear minutes or even hours before the retail crowd recognizes a trend, giving sophisticated traders a massive edge in timing their entries. The concept of liquidity is absolutely critical and misunderstood by 90% of traders out there. Price doesn't move randomly. It moves from liquidity pool to liquidity pool like a heat-seeking missile. Elite traders ask themselves a simple question before every trade: where are the stops located? Because wherever stop losses cluster, that's exactly where price will be drawn to before making its real move. Think about a typical bull trap scenario where price pushes above a key resistance level, triggers breakout traders' entries and stops from short sellers, then immediately reverses downward. This isn't bad luck or market manipulation in the conspiratorial sense, it's simply how markets function. Smart money needs liquidity to fill their large orders, and retail stop losses provide that liquidity. By understanding this mechanism, elite traders position themselves opposite the crowd, entering short when everyone else is buying the breakout, or buying when panic selling creates capitulation. Time frame alignment is something that separates professionals from amateurs more than almost any other factor. Elite traders don't just look at one time frame and make decisions, they're constantly synthesizing information from multiple time frames to understand the complete picture. The weekly chart might show a strong uptrend, the daily chart shows a pullback creating opportunity, the 4-hour chart reveals a structural shift, and the 1-hour chart provides the precise entry trigger. This multi-timeframe approach allows traders to enter early on lower timeframes while being aligned with the higher timeframe trend, dramatically improving their win rate and risk-reward ratios. When an elite trader enters what looks like an early or aggressive position, they're not gambling. They're entering on a lower timeframe signal that aligns perfectly with higher timeframe structure. The retail trader waiting for confirmation on the daily chart is entering exactly where the professional is taking partial profits. Volume analysis provides crucial confirmation that price movements have substance behind them. Price can move up or down easily on low volume, but these moves typically don't sustain because there's no real conviction behind them. Elite traders look for specific volume signatures that indicate genuine institutional participation rather than retail noise. When you see increasing volume on a breakout, that's confirmation that large players are involved. When you see climactic volume at a bottom with a reversal candle, that's often capitulation followed by smart money accumulation. The volume patterns that precede major moves have characteristics that can be identified with practice. Volume often increases as a trend matures and reaches exhaustion, then decreases during consolidation phases where accumulation or distribution occurs quietly. By the time volume expands again with a breakout, elite traders have already established positions during the quiet accumulation phase. Market profile and auction market theory provide a framework that elite traders use to understand value and price acceptance. Every trading session is essentially an auction transaction where buyers and sellers negotiate to find fair value. The market profile displays where the most trading activity occurred during a session, creating a bell curve distribution that shows the value area. Elite traders pay attention to where price is relative to this value area because price tends to return to value after extended deviations. When price is trading below value and starts showing signs of acceptance at higher levels, that's an early signal that value is shifting upward. The composite profile showing multiple days or weeks of data reveals longer-term value areas and the structural framework within which short-term price action occurs. Understanding these concepts allows traders to identify when price is likely stretched and due for mean reversion versus when a genuine value shift is occurring that will lead to sustained trending. The role of catalysts and narrative cannot be ignored when discussing early entries. Elite traders don't trade in a vacuum. They're constantly aware of the fundamental backdrop, upcoming events, and prevailing market narratives. However, they use this information differently than most people. Instead of waiting for the news to be released and then reacting, they position themselves ahead of anticipated events when risk-reward is optimal. If earnings are coming for a stock and options flow suggests institutional positioning for a move higher, an elite trader might enter days before the event while implied volatility is still reasonable. By the time the news is released and retail traders are rushing in, the sophisticated trader is already managing a profitable position. This forward-thinking approach requires understanding not just what the news is, but how markets are likely to interpret and react to it based on current positioning and sentiment. Contextual awareness separates pattern recognition from genuine edge. A breakout pattern that appears on your chart might look identical to 50 other breakout patterns you've seen, but the context surrounding each occurrence determines whether it has high probability or not. Elite traders consider where the pattern appears relative to major support and resistance levels, what the higher time frame trend is doing, whether volume confirms or contradicts the pattern, what the overall market environment is like, and whether sentiment is positioned for or against the move. A bullish engulfing candle at a major support level during an uptrend on increased volume has completely different implications than the same candle pattern appearing at resistance during a downtrend on low volume. Context is everything, and developing this contextual awareness takes thousands of hours of screen time and deliberate practice. The psychological component of early entry trading is perhaps the most challenging aspect to master. When you enter a trade early, before confirmation, you're going to be wrong sometimes and you're going to experience discomfort even when you're right. Elite traders have developed the emotional resilience to sit through the normal noise and volatility that occurs before a trade moves in their favor. When you buy a pullback in an uptrend, price might continue pulling back for several more candles before reversing. The amateur exits prematurely due to fear, while the professional understands that this uncertainty is exactly why the opportunity exists. If it felt comfortable and obvious, there would be no edge. The ability to tolerate ambiguity and maintain conviction in your analysis while price temporarily moves against you is a skill that must be developed deliberately. Elite traders use position sizing and risk management to ensure that even when they're early or wrong, the damage is controlled and they can continue trading. Reading institutional footprints requires understanding how large orders impact market structure. When a bank or fund wants to buy $10 million worth of a currency pair or stock, they can't just market order it without causing massive slippage. Instead, they accumulate over time, often during consolidation periods or pullbacks. This accumulation creates specific patterns. You'll see price holding above a certain level despite repeated tests, absorption of selling pressure without significant downside follow-through, or narrowing price ranges on decreasing volume as supply gets soaked up. Elite traders recognize these accumulation signatures and position themselves alongside institutional flow rather than fighting against it. The opposite occurs during distribution, where smart money is offloading positions to late-arriving retail participants. Price might grind higher on decreasing momentum and weakening internals, even as headlines become increasingly bullish. Recognizing distribution allows elite traders to avoid buying tops and potentially position for reversals. The concept of relative strength and weakness provides powerful early entry signals that most traders overlook. In the stock market, elite traders constantly compare individual stocks to their sector to the overall market, and the overall market to different time frame trends. A stock showing relative strength by holding near highs while the market pulls back is displaying institutional sponsorship and often provides early entry opportunities before it makes new highs. Similarly, relative weakness during market strength identifies potential short candidates. This comparative analysis works across all markets. Currency pairs showing strength or weakness relative to their correlations, commodities responding to dollar movements, and crypto assets moving independently independently of Bitcoin. When you identify a leading instrument showing exceptional relative performance, you've found where the smart money is positioning, and you can align yourself with that flow early. Advanced traders use correlation and intermarket analysis to anticipate moves before they fully develop. The relationships between bonds and stocks, the dollar and commodities, or gold and real rates provide leading information about directional bias. When bond yields are rising sharply, elite equity traders know this creates headwinds for growth stocks before the sector actually breaks down. When the dollar makes a structural low, commodity traders begin positioning long before the obvious trend develops. These correlations aren't perfect and they shift over time, but understanding the general relationships allows you to have a directional bias that improves entry timing. You're not waiting for your specific market to confirm, you're reading the broader ecosystem and positioning in anticipation. The power of confluence cannot be overstated when it comes to high probability early entries. Elite traders don't take trades based on a single signal, they wait for multiple independent factors to align at the same price level or time. Imagine a scenario where a daily chart shows a Fibonacci retracement level coinciding with a previous support zone. The 4-hour chart displays a bullish divergence, order flow shows absorption of selling, and the weekly trend is bullish. This confluence of factors from different analytical approaches, all pointing to the same conclusion, dramatically increases probability. The entry might still feel early compared to waiting for a breakout, but the confluence provides conviction that this is a high-quality setup worth taking. Building a systematic approach to identifying confluence zones is one of the most important skills an aspiring elite trader can develop. Understanding market cycles and positioning for phase transitions gives sophisticated traders enormous advantages in timing. Markets move through distinct phases: accumulation, markup, distribution, and markdown. Each phase has characteristics that can be identified, and the transitions between phases offer the highest probability opportunities. During late accumulation, price appears boring and choppy, volatility contracts, and most traders lose interest. This is precisely when elite traders are building positions before the markup phase begins. Similarly, recognizing distribution after an extended trend allows traders to exit before the markdown phase or position for reversal. The majority of traders finally become convinced of a trend during the late markup or early distribution phase, which is exactly the worst time to enter. Cycle awareness keeps elite traders ahead of the curve. The use of options flow and derivative markets provides insights that pure price action traders miss entirely. When you see unusual options activity with large positions being established in near-term contracts, someone with significant capital is expressing a directional view. Elite traders monitor these flows for clues about how sophisticated participants are positioned. A sudden increase in put buying might precede a decline, while aggressive call buying could signal an impending rally. These derivative positions often get established days or weeks before the underlying asset makes its move, providing early warning signals. While you don't need to trade options to benefit from this information, being aware of positioning in the options market adds another layer to your analysis. The discipline of constant review and adaptation separates traders who improve from those who stagnate. Elite traders maintain detailed journals not just of their trades, but of their thought process, the market context, and what they observed. They regularly review this data to identify patterns in their decision-making, both positive and negative. They notice that certain setups consistently work better for them, that specific market conditions favor their approach, or that emotional states impact their execution. This feedback loop of execution, review, and refinement creates continuous improvement over time. The early entry techniques that work in trending markets might need adjustment in range-bound conditions, and only through systematic review can you identify these nuances. Technology and tools have leveled the playing field in many ways, but elite traders use technology as an enhancement rather than a replacement for skill. Advanced charting platforms, custom indicators, heat maps, and screening tools help identify opportunities faster, but the interpretation still requires human judgment. Algorithmic traders and high-frequency firms have advantages in speed, but human discretionary traders maintain advantages in pattern recognition, contextual assessment, and adaptation to novel conditions. The key is using technology to augment your natural abilities, letting scanners identify potential setups while you focus on evaluating quality, using alerts to monitor multiple markets while you concentrate on execution, or employing analytics to measure your performance objectively. The integration of top-down analysis with bottom-up execution creates a comprehensive trading approach. Elite traders start with the macro view, what's happening in the global economy, central bank policy, sector rotation, and major market themes. This creates a directional bias and identifies where opportunities are likely to develop. Then they move to specific instruments that align with their macro view, analyzing these on multiple time frames to find concrete setups. Finally, they execute on lower time frames with precise entry triggers that minimize risk while capturing early position entry. This funnel from macro to micro ensures that individual trades aren't occurring in isolation, but rather as part of a coherent strategy aligned with larger forces. Risk management at the professional level is sophisticated and goes far beyond simply setting stop losses. Elite traders think in terms of portfolio heat, correlation risk, position sizing based on setup quality and market conditions, and maximum acceptable drawdown. They might take larger positions on highest conviction setups, where multiple factors align while keeping smaller size on lower conviction trades. They understand that risk is dynamic. A position entered with appropriate risk might need to be reduced if market conditions change or correlation increases. The goal isn't just to be right on individual trades, but to manage the overall portfolio in a way that generates consistent returns while controlling volatility. This portfolio-level thinking is foreign to most retail traders who focus exclusively on individual trade outcomes. The journey to becoming an elite trader who consistently enters early and captures optimal returns is measured in years, not months. There are no shortcuts or secret indicators that replace the necessity of screen time, experience, and skill development. What you can do is accelerate your learning by studying how professionals think, deliberately practicing the specific skills that matter most, and maintaining the discipline to follow your process even when results are temporarily unfavorable. The traders who succeed long-term are those who fall in love with the process of trading rather than just the profits, who view losses as tuition and learning opportunities rather than failures, and who commit to continuous improvement regardless of current skill level. The techniques covered today represent a fraction of what elite traders know, but implementing even a few of these concepts will dramatically improve your entry timing and overall results if you apply them with discipline and consistency. Your trading career is a marathon where compounding small edges over thousands of trades creates extraordinary outcomes.